All right, well, good morning, everyone, and thank you so much for joining us for the CAR Economic Forecast. My name is Laura Sager. I'm part of the Membership and Education Department here at the Conejo-Simi Moore Park Association of Realtors. So happy to have you here today. Jordan and I will be monitoring the Q&A section. If you have any questions, feel free to type them in the Q&A, and we will do our best to monitor those. I will introduce our presenter. Jordan Levine is the Vice President and Chief Economist at the California Association of Realtors. Jordan is responsible for CAR's housing market and economic research, as well as policy analysis for CAR's legislative and governmental affairs efforts. He has a passion for home ownership, fair housing, and housing supply, and regularly represents CAR to its members, industry groups, policymakers, and in the media. Please welcome Jordan Levine.
Laura, thank you so much. I appreciate the opportunity to be here, and thank you all so much for your time. I'm going to share my screen so that we can look at some pictures together, which always say more than words ever could, and talk a little bit about what's going on in the broader economy. And of course, you know, the moral of the story, I think, is that our clients out there, both buyers and sellers, have a lot of negative headlines that they're up against. I think they're thirsting for information. This is definitely an environment where I think the data is going to be your friend. We have a lot of conflicting headlines too. Most of them are scary, but actually I think that when you get really hyper focused and bogged down on the latest newspaper headline, you can kind of, you know, miss some of the opportunities that are out there. And I think you have, on the one hand, buyers on one extreme that think it's a terrible time to buy and why would I get into the market? Rates are up a lot, to the complete, you know, polar opposite, where you've got buyers out there who think it's 2008 all over again, and we're going to come in and name our own price and get all these concessions and rate buy downs, and they're going to pay closing costs and everywhere in between. And at the same time, I think you've got sellers who've been scared off as well, because they think that the market is in the midst of a shift, and not realizing that actually, as rates have come back down from 7 to 6.5, or even a little bit lower than that, that the market has just tightened right back up in terms of competitiveness, and homes are still selling fairly quickly, and we haven't seen prices move that much. And so I think, again, this is an environment where you really want to lean on the data heavily and not make impassioned pleas or try and convince anybody to do anything, but where you can kind of show the realities of the market, and that it isn't, you know, as bad as maybe what your brother-in-law suggests. And I always kind of joke that your brother-in-law is the one who's always sending you these email newsletters talking about how things are about to fall apart and just wait for the foreclosure crisis, et cetera. And so we'll talk through some of the numbers behind that, and why I just don't think we have the same ingredients for the kind of downturn that we had last time, even as, you know, we can all see that the market has certainly shifted out there. I think first and foremost, we got to take some of these big headlines on, you know, right up front, talk a little bit about the recent crisis, quote unquote, in banking. And we know that Silicon Valley Bank went down in early March, and actually it was just one of several banking challenges and interventions that we had to see throughout the marketplace. And this caught a lot of headlines because it was the second largest bank failure we've seen, behind Washington Mutual back in 2008. And of course, bigger than some of the more high profile bank failures that we saw during the last housing cycle, including places like Indian Mac and Guarantee Bank, and even Colonial Bank back in 2009. This was an institution with roughly $200 billion worth of assets, and just slightly less than that in terms of deposits. And you can see in the kind of history of their deposits that they really were emblematic of this kind of broader tech counter-cyclical boom that we saw, similar to what we saw actually in the housing market. But if you go back to the start of the pandemic, when we, you know, weren't allowed to leave our homes, the rest of the economy suffered incredibly, and we lost almost 2.7 million jobs overnight. But like Silicon Valley Bank in particular, just the tech sector more generally saw the opposite, right? That business was booming. We were stuck on our couch buying things while we were sitting there in sweatpants and playing online video games and buying stuff from Jeff Bezos and all of that kind of stuff. In many cases, we saw tech revenues going up 30, 40, 50%, even at the onset of the pandemic when unemployment was rising into the double digits. And you can kind of see that reflected here in the deposits at Silicon Valley Bank, because this was a bank that was highly focused on technology companies that both did their banking there. But then this bank also took those deposits and redeployed them back out into the tech sector as investments. Well, in 2022, as the pandemic started to fade into the rearview mirror, we saw the goods producing sector start to come back online. We were doing things outside again. The service sector do a lot better, right? We were allowed to go back outside, meaning that we were hitting all those bars, restaurants, hotels, going on vacation, and those kind of online companies that had been doing so well during the pandemic started to peter out. And so we weren't seeing the same increase in new deposits coming into places like Silicon Valley Bank. In addition, the investments they made with that money had started to lose some momentum, and actually deposits were going down through the first couple of quarters of 2022. And they announced that they were going to have to go ahead and start raising some capital. Well, capital wasn't as plentiful in an environment where we didn't have 0% interest rates. Investors have a lot of other options for what to do with their money, meaning that, they couldn't go out and just raise traditional venture capital or things like that in normal financial markets. And of course, folks started to get worried and wanted to pull out money. And we saw a run on that bank where about 40 billion of the roughly 180 billion that they had on hand, quote unquote, was attempted to be pulled out. The FDIC had to step in and actually shut this bank down. Their problems were compounded by the fact that the other thing they did with their money at the start of 2021 was to really buy a lot of US treasuries, right? So they had so much cash, they were deploying it into these tech companies. In addition to that, they were buying bonds. And I'll spare you the boring bond market lesson, but I'll just say that bond prices moved the opposite way as interest rates. And so as the Fed really embarked on this kind of militant war against inflation and started raising short-term rates, incredibly, the value of the bonds that Silicon Valley Bank purchased during 2021 were, unfortunately worth a lot less than what those face values said on secondary markets. And so when it came time to raise capital and they couldn't get other funds, they had to dump a lot of these assets at a loss. And again, only raised greater questions about the viability of this institution, and again, led to that run that we saw back on March 9th. It actually got started a little bit earlier. Silicon Valley Bank was the one that grabbed most of the headlines, but on the 8th, the day before the bank run, we saw Silvergate Bank, which is also based in the Silicon Valley, wind itself down. On a call with investors. They said they were going to go ahead and shutter. And that was also one of these banks that really was heavily focused in technology. A few days later, Signature Bank in San Francisco went down. About 3 days later, Credit Suisse, which is a more broadly focused bank that isn't so hyper invested in technology companies, saw their values go down about 30% almost overnight. Another Bitcoin focused bank in New York went down as well. And so this was really just the first of several dominoes to fall that I think aren't necessarily indicative of a broader banking crisis per se, where we're going to see mass bank failures, but rather kind of highlights the challenges that I think companies in general are going to face now that rates have come up, right? When you have a zero interest rate environment, there wasn't a lot of options for investors to place their money except in, kind of the stock market, right, in equities or in real estate. And of course, we benefited from that during 2020 and 21 as well. But I think, when you kind of look at it from a 30,000 foot perspective, the financial market was running pretty hot. This is something I like to look at to see how hot the financial market is running. It's kind of like doing a price to earnings ratio for an individual stock. You look at what the value of that stock is, and you look at how much money that company is making in terms of earnings. And if you do that calculation for the economy as a whole, the stock market is typically between 7 and 11 times earnings out there. And if you look at where we were back in 2021, you could see that we were almost 18 times earnings, meaning that even as companies were doing well and profits were rebounding from the pandemic, that they weren't enough to justify how valuable these companies were on financial markets and being valued by investors. And you can see on the right hand side that even as the recent dip from 40,000 on the Dow or so down to 32,000, and the kind of ebbing of home prices, the price to earnings ratio is still a little bit out of whack. And I think this is symptomatic just of the broader financial challenges that companies are going to be facing moving forward, where capital is not going to be flowing as freely. The threshold that you have to cross in terms of generating a return is much higher when someone can take their money and put it in a 5%, guaranteed online savings account and assume absolutely no risk, meaning that a lot of these companies aren't going to be able to get their hands on as much capital, and we could see those valuations continue to ebb back towards that normal range. And you can kind of see this if you look at it in terms of the commercial market, right? Commercial real estate has become a growing concern for many out there. And you can see here on this long-term history of CMBS delinquency rates that even as the kind of total delinquency rate across all commercial property types has started to go down, it's really been a function of both a very strong industrial sector and a hotel market that was hit hard during the pandemic, but has really been recovering at a pretty solid clip as we're able to go outside of our homes again. If you actually look at the light blue line, though, you can see that the office market is kind of on the upswing in terms of facing those challenges. During the pandemic, we had a lot of folks that are locked into long-term leases. And I think we're only now starting to see the effects of work from home and the kind of more structural changes that COVID ushered in affect that segment in particular. And that's one of the only areas where we're seeing CMBS delinquency go up, meaning that, rent capture and vacancy rates or rent capture is going down and vacancy rates are going up, and those investors aren't getting the same kind of remittances on these CMBS portfolios for office in particular. And I think that is a trend that still has legs. I don't think you're going to see the bottom fall out of the market. I think as the economy cools in particular, we know that employers want folks back in the office, but with such a huge labor shortage going on out there that we'll talk about in a second, I think that we'll still see the commercial market, continue to struggle. And I hear about this anecdotally with more space, and we're not able to sublet out the space that we are on the hook for quite as easily. But I think that we're not seeing the bottom fall out even in the commercial real estate side of the market. Of course, we're still in the midst of this Fed tightening cycle, and what I'm showing you here is the last 12 cycles that we faced where the Fed was raising rates to get inflation under control. And you can see on this chart that it usually doesn't end well, as the Fed really jacks up rates significantly to pump the brakes on the broader economy. It is very correlated with a recession. In fact, 9 out of the last 12 tightening cycles have ended in recession. And if you look at the trajectory for where the Fed says they're taking us, it looks like we could be headed that way as well. The good news is we're starting to get the lid on inflation. We just got new data for March the other day. I'm coming back off of vacation and trying to catch up on all the data. But one of the things I did notice right off the bat was that CPI growth continues to fade, although part of this is due to energy prices. And I was just out buying gas, so I know that started going back up again recently. But we have come down from about 9% inflation to 5% or so in the most recent data. And that's been a pretty consistent improvement. And so we are moving in the right direction on a fairly sustained basis, but we're still about 2.5 times higher than where the Fed wants us to be. And even as I know a lot of folks were hoping that the Fed would do nothing or maybe even cut rates last time, they actually came out and raised them even in the face of these recent banking failures. And I think it isn't unlikely that the Fed may raise rates again at least one more time before the dust settles on these numbers, because they are, again, very hyper focused on getting inflation under control, and have even broadcast that they're willing to accept more unemployment and a slower economy in order to get us there. But, if you look at it from a kind of nuts and bolts standpoint, and I think one of the reasons why we're still seeing a housing market that's holding up relatively well is that even with these high profile layoffs that we've seen, banking failures, et cetera, if you look at the labor market, which I think is what matters most for the housing market, we're still in a labor shortage situation. I'm showing you the number of jobs and job openings compared to the folks that are either working or looking for work. And you can see that even as it's, kind of come down from those all-time highs that we hit back in 2022, we still have about 4.2 million more jobs than we have workers that are out there looking for jobs to fill those positions. And I think that's both why we can expect that it'll take a few more months before we get inflation totally under control, and perhaps even towards the end of the year, but also why I think, we aren't seeing the bottom fall out in terms of demand or consumer spending and things like that, because most people that want to work are actually still working. Here in California, we got a report from the state a month ago, or about 2.5 weeks ago, that showed the recovery is even stronger than what they originally reported. They go through an annual benchmarking process where they go through and sync up their monthly estimates on the basis of what they see happening in the actual unemployment insurance filings that folks are paying into the unemployment insurance system here in the state. And California is running even hotter than what we had seen over the course of the last 12 months. If you look at new claims for unemployment insurance, and these run right up through the last week of March, there hasn't been a noticeable uptick, right? So again, even as we've seen a lot of high profile layoffs and some companies kind of going under and things like that, you're not seeing more folks increase their need, reliance on the federal government. We're not seeing a big uptick, at least in the number of folks that are going onto the government payroll every week. We're still at fairly healthy levels in terms of new unemployment insurance claims. I think maybe the one thing you could possibly say is that it's taken folks slightly longer to get back to work compared to where we were last year. This is continuing claims, so how many folks, aren't filing for the first time but are refiling for their next week of unemployment insurance. And those numbers have gone up very slightly from where we were at the end of last year. And I think that just means even as we're not adding more and more folks to the payroll, we are seeing that they're staying on slightly longer, meaning that, this could be the first sign that the labor market is cooling, but again, not falling apart. And so folks are still out there earning incomes. Incomes are actually still rising at an above average pace. And so even as scary as the economic news has been of late, it hasn't translated into a big increase in the number of folks losing their jobs or major concerns about mass layoffs across the state. That being said, I do think that we can expect consumer spending to slow down. And this is relevant because 70% of the US economy is still based on consumer spending. And about 95% of all of the economic growth that we've enjoyed up to this point in the recovery has come from consumers. And I do think that even with, not a big increase or surge in unemployment, we can expect consumers to potentially, lose some momentum, is because how, we've been able to maintain the growth that we've had up to this point is because consumers have been getting increases in their wages at a above average pace, but it's been about 4 to 5%, not the 9% that prices were increasing by up until recently. And we've had to really bridge that gap by drawing down our savings accounts and running up our credit cards. And you can see that the sustainability of those trends, I think, is starting to wane. You're even seeing consumers start to rebuild savings a bit during the first quarter as we dropped from double digits during the pandemic when we were getting free checks from the federal government down to the low single digits. And more importantly, we're seeing debt balances really climb to all-time high levels. In fact, if you go to January, revolving debt, which is the econ nerds way of saying credit cards, was growing at a 16% annualized clip. And of course, we can only take savings down to 0%. And eventually your credit card gets maxed out. And I think that could spell a bit of a breather for consumers. And we don't have many other areas of the economy to fall back on in terms of economic growth. Again, consumers have been almost all of the growth up to this point, and I think they're going to start to lose some of that momentum. And even if we don't fall into what would be a technical recession by the standards of the National Bureau of Economic Research, I think we can expect that the economy will be a bit slower than we've enjoyed up to this point. The other thing that I like to look at in terms of a leading indicator to see where the economy yes, and I'm just checking Chuck's comment. He said the tech sector has had thousands of layoffs, yet it didn't seem to move the needle on unemployment insurance claims. Yeah, exactly. And I think this is a function of both, or a nice juxtaposition between the headlines, right? And you hear about Facebook laying off 15, 20,000 people, Twitter, which is kind of a special case, these banks winding down. And yet, when you look at the aggregate numbers, right, even in the Bay Area, I think employment was still growing through the first couple of months of the year. And that's just a function of even as folks lost their jobs, they were getting back to work fairly quickly. There's still, again, a excess of open positions, meaning that when folks have lost their jobs, especially in a lot of these technology jobs, they're just going to other companies, and unemployment actually still remains very low. It's a great point, and I think that's the kind of context that consumers, buyers, and sellers out there need, right? Because they hear, oh my gosh, Facebook laid off 20,000 people. They think all 20,000 people are in the Bay Area, or that actually results in increased unemployment overall, and that simply hasn't materialized, at least not in the data up to this point. The other thing, though, that I think kind of points to a slowdown amongst consumers in particular is what I'm showing you on this chart. This is growth in real net worth per capita. It's a measure of household wealth in the United States, and the reason why I'm showing you this is because it's been in decline for the last 3 quarters in a row, but also because each time we've seen a sustained reduction in household net worth, meaning that folks are actually poorer than they were at the same time last year, it coincides very closely with our official recessions. And you can see going all the way back to the 1960s or even the 1950s, anytime that the American household was getting poorer on average, it wasn't good for the economy. This is both very predictive, but also just very intuitive, right? When I'm getting richer, I go out and spend more money and propel the economy forward. And when I feel poorer, as I have for the last 3 quarters in a row, it suggests a period of belt tightening where I'm not going to spend as much money. I'm not going to take that vacation or buy that new TV at Costco, or what have you. And I think, again, this is suggestive of maybe not an official recession, but at least a slowing amongst consumers, because not only are my savings accounts running dry and my credit card, being nearly maxed out, but I'm also now feeling poorer on top of that. And that's the kind of trifecta when it comes to tightening your belt as a consumer. And again, we don't see much growth coming from business investment or, commercial real estate, government spending, or international trade, meaning that as consumers step back, we should expect that to show up in the broader economy, meaning that our clients, our buyers and sellers, aren't going to enjoy that rapid job growth. We could see the labor market slacken somewhat after being so out of whack with so many open jobs, and that jobs won't be as plentiful as they have been up to this point. And I think that's another factor that we have to consider when we think about things like housing demand having been so strong for the last 3 years, particularly hypercharged by these very low interest rates, but also just an improving economy that was rebounding at a fairly rapid clip. And you can see the consumers, even as we've been the one and only source of growth since the end of the pandemic, we haven't felt particularly good about all the money that we've spent. Consumer sentiment is down. It's actually up a little bit in January, February, from where it was at the summer of 2022 when rates really started to go up at a rapid clip. But compared to where we were even before the pandemic, consumers aren't feeling particularly bullish about their current economic conditions. And again, just more support for the idea that we should expect the economy to start to slow as we get into the second quarter and the third quarter of the year. And indeed, if you look at the real time consumer spending numbers, and this is retail sales through February, and we're very eagerly awaiting the March number, but you can see once you net out the inflation growth in real consumer spending, which is that kind of inflation adjusted spending number that we get on a monthly basis, you can see that we've either been flat or negative for the better part of the last year, going all the way back to last March when rates were still very low. And again, I think this all just points to the idea that consumers are losing steam. And again, I think that has implications for the broader economy. And when you look at the financial market, it seems to kind of agree with that number. What I'm showing you here is the yield curve. The yield curve is a very esoteric, nerdy macroeconomic data point, but it's one that's also very highly correlated with a recession. It's measuring the difference between interest rates on short-term treasuries and long-term treasuries. And when it goes negative, what it means is that the rate on short-term assets is actually higher than the rate on long-term assets. And typically that's not the case. The longer I loan somebody money, the more I'm going to charge them for the extra risk, the extra opportunity costs that I'm foregoing to invest my money in other opportunities. And again, when you see this go negative, meaning that short-term rates have gone higher than long-term, it means that people are skeptical about buying those short-term treasuries, and you really have to raise rates or lower the price on those assets in order to get demand going again for those short run treasury products. And when you look back over the last 40 years or so, you can see that any sustained yield curve inversion has been followed by a recession of at least some length. And we've now been inverted for the last 9, almost 10 months consecutively, and actually more inverted than at any point over the last 3 business cycles, again, going back to the 1980s. And so the leading indicators suggest that we should see the economy slow down as well, meaning that our buyers and sellers out there aren't going to be enjoying the kind of robust economic environment that we've seen up to this point in the cycle. Rates have actually come up quite a bit from where we were even at the beginning of last year, but certainly from those all-time low levels at the end of 2020, early 2021. Paradoxically, this challenge with financial markets and these bank failures in particular have actually given us a bit of a reprieve when it comes to mortgage rates, because as people get freaked out about what's happening in the stock market, they tend to pull that money out, put it in those safe haven treasury bonds, and you can see that the 10-year has come down pretty substantially from where it was back in March, and that has translated into a 30-year fixed rate mortgage that has dipped back down below 6.5% after rising to over 7% earlier this year and during the latter half of last year. This is actually a window of opportunity for buyers who want to take advantage, but it also kind of leads the market to become more competitive as buyers try and get in while the getting is good. This is one of those things that your brother-in-law kind of leaves out of his email newsletter campaign telling you how bad the housing market is doing, is that rates have actually come down about 70 basis points from where they were over the course of the last couple of months. That's actually a good thing for buyers, and especially considering that the Fed funds rate is now in excess of 5%. I think there's a chance that we could see rates go back up as that kind of fear and uncertainty about financial markets ebbs and folks move back out of treasuries over the next couple of months. One of the interesting things, though, and you can see that in the daily data, the treasury market has started to stabilize, right? It was dropping pretty precipitously in the wake of Silicon Valley Bank, but those numbers for the 2-year and the 10-year have started to stabilize. One of the kind of upshots is that the gap between the 2 and the 10-year has also stabilized. It's not running as big as it was. And I think this recent inflation report that we got with the CPI coming below 6% for the first time in the better part of a year has helped with that. But you can see that the yield curve is still inverted, and both rates for 2-year and 10-year treasuries are still well below where the Fed funds rate is. And so unless you're really optimistic that the Fed's going to start cutting rates and that this inflation is going to come down more rapidly than what it has done up to this point, I think there is a chance again that we could see mortgage rates go back up before the dust ultimately settles. And this is, of course, where the rubber meets the road for us as real estate professionals, right? You can see here that mortgage applications, and these are just purchase applications, by the way, we've gotten rid of the refis in these numbers, but buyer demand is still running well below where we were, not just during the pandemic or the kind of immediate aftermath when buyer demand surged through the roof, but even below the kind of pre-pandemic levels. In fact, last week we had fewer mortgage applications than we did even at the worst of the kind of shutdown when we weren't even allowed to go out and look for homes. And I think this is something that's both a function of higher interest rates, right? And also that brother-in-law effect where you have even qualified buyers that are still sitting on the sidelines because they're kind of suffering from that psychological scar tissue from 2008 where they don't want to be the last buyers into the market and have kind of drank the Kool-Aid on these negative headlines that the bottom will fall out of the market and we just need to wait to get a better deal or a lower price and even better interest rates as we hit 5% later this year. I keep reading articles that we're going to be at a 5% mortgage rate by the end of the year, and I just don't think that's in the cards when you look at how tight the labor market is and the fact that the Fed will probably still raise rates one more time. And I think that the purchasing power impact is certainly alive and well of higher rates, but I also think we need to be getting folks refocused on the long term again, because we just simply don't have the ingredients for the kind of 2008 price declines that we saw, meaning that the longer you wait, you could just be facing even higher rates and higher prices down the road and missing an opportunity as rates have dipped back down below 6.5%, and the market is although heating up, not as competitive as it was this time last year. And that is the kind of perspective and context I think that you can really provide to those buyers who can still afford and want long-term home ownership. But you can see that sales, although up slightly in February, are still running well below where we were at this time last year. We've been below 300,000 units now for about 8 months in a row. We were down below 250,000 units for the 3 months leading up to this. And again, I think that although the worst is probably behind us in terms of overall transactions, I think the climb back to that 450 or even 500,000 unit range that we hit back in 2020 is going to take us a while to get there. And indeed, if you look at the weekly data, and this is closed sales that run right up through the weekend, right, the 10th of April, you can see that we're still running well behind last year's pace, and we are getting that kind of seasonal uptick as the spring home buying season starts to take root. But we're not getting back up to the levels that we were at even last year, let alone the kind of pre-pandemic numbers that we saw in 2018 and 19. Pending sales, though, as rates have come down, did pop over the last 2 weeks, and I'm hopeful that we'll continue to see sales rise through the spring. But again, they're just going to be more depressed than what we've enjoyed during the preceding 3 years when we were setting 15-year highs for buyer demand. So I don't think we need to panic about transactions falling materially from where we've been. In fact, we were down at 240,000 or so units a few months ago. I just think that we need to keep our belts tight, as it were, as we head into spring, and really kind of we're going to be working really hard for those buyers, because the number of homes out there available to put these buyers into is going to be the limiting factor. And even with rates so much higher than they are, I'm becoming less and less concerned about where we find the home buyers and more concerned about where we're going to put them. Because don't forget, most folks in California that want to work still have jobs. We still have a lot of high income earners. Not everybody can absorb the recent increase in interest rates, but you've got a lot of folks sitting on the sidelines, potentially unnecessarily, and missing an opportunity before rates go back up and the market tightens further from where it already is. And I brought a bunch of local data just to kind of show you that same trend playing out. And we had incredible growth across, the Conejo Valley and even North Los Angeles County as well, that has started to peter out. In fact, we had incredible growth in 2021 when rates were at all-time lows, but last year we saw the same story that we saw play out statewide, right? Where we didn't just fall back to those pre-pandemic levels, we saw some of the lowest levels that we've seen going back a number of years. And again, you can see, and these are again sorted from lowest price on the left to highest price on the right. But we had a run of a couple of really good years with double-digit growth, in particular in 2021, that we really gave most of that back in 2022 and continue to fall from those levels through the first 3 months of 2023. The good news is, I think that prices, we haven't seen the bottom fall out of the market. So this is closed prices on the statewide level, and we are seeing that typical seasonal ramp up, right? As the winter came, we saw prices decline, and we were going down on a month-to-month basis for about the last 6 months consecutively, and even saw our first year-to-year declines in the last decade as well. But what you can see is that as demand starts to ramp back up just in our normal seasonal pattern, yes, we're below where we were at this time last year, but the bottom doesn't appear to be falling out. In fact, we could argue that we're just kind of stabilizing even a little bit when it comes to the overall median price. When you look at it on an annual basis across the local market, you can see that same moderation pretty much across the board. Newberry Park is the one exception where the median price this year is actually higher than it was through the annualized numbers in 2022. But for the most part, you are seeing that moderation. Part of this is because we're not selling as many homes at the top end of the market. If you look at a place like Calabasas in particular, in 2021 and 22, a huge portion of the market was concentrated at the very top end. And as we've seen the market normalize away from the very high price segments back down towards the middle and even the bottom end of the market, it's kind of exaggerating some of those price declines, meaning that it's not as bad as what that headline number would have you believe. But some of this is also real, honest to goodness reduction in home buyer demand as well, that's causing prices to soften a little bit. Keep in mind though, and I don't know why this says Central Valley, I will get this changed before I send these to Laura. And I should note also that you'll have access to all these slides to use in conversations with your clients, but you can see that we're coming off 3 to 4 years of really exceptional growth across the region, almost without exception. So yes, in 2023, prices are down a little bit, and I just showed you that in terms of overall medians, but prices were up anywhere from 30 to 50% in aggregate if you accumulate just even the last 2 to 3 years of growth leading into this. So yes, prices are down a bit, but it's not the case that we have a lot of upside down homeowners with negative equity. In fact, if you go read the California economic forecast that's put out by a group located in the Central Coast where I live, they quoted our very own Chuck Leck pointing that specific item out, right? That we have homeowners out there with a lot of home equity. The percentage of homeowners with home equity is high, and the level of that equity is also near an all-time high level, even with the recent price declines that we've seen. And when you look at it through the lens of the underwriting that we did, where most folks came in with very high credit scores and lots of money down because that was simply what the market dictated, right? That inventory was so tight, demand was so high that the offers were getting accepted by people who could close quick, put lots of money down, right? Or pay all cash. And so again, even with recent price declines, you don't have a lot of upside down homeowners that want to throw their keys back to the bank, especially because they have the lowest interest rates of all time. And rather than, significantly slash price and dump the property and get out from under the home, you have a lot of folks who are just gonna kind of camp out on these low rate mortgages that they currently have. The other thing is, where are you gonna go, right? Unlike 2008, where you could throw your keys back to the bank and literally go rent the house next door for about $1,000 a month less, the rental market is even tighter than the for sale market. And I think that kind of precludes these major price declines that your brother-in-law is forecasting. And you can see that if you look at the stats on the mortgage market. I went through looked at all 2.3 million loans that Freddie Mac makes available in this big giant spreadsheet. These are the loans that they underwrote or backed and securitized for sale onto the secondary market. Well, 83% of those homeowners out there are currently sitting on interest rates that are at or below 4%. And you have about 99% of those folks below 5%. And this, of course, creates a significant lock-in effect because you don't want to move. Even if you bought a house that costs exactly the same as the home you sell, it's going to cost you a lot more in terms of your monthly mortgage payment by going from 3 or potentially even 2.5% up to a 6.28 or whatever the most recent Freddie Mac number is. And indeed, you can see the homeowner equity that Chuck so eloquently pointed out in that quote is still very high relative to any other point in time. Yes, it's moderated a little bit as prices have come down a little bit. But again, the percentage of owners with equity is near an all-time high level, and the amount of that equity is also high. And most of those folks are paying these mortgages on time. The most recent delinquency rate we have on mortgages in California is just 2.5%. If you look at the historical average over the last 40 years or so, I guess actually now the 1970s is like 50 years ago, which is sad to say. But if you look at that historical average, we almost always have a delinquency rate of about 4.2%. And so we are currently well below even a normal level, and certainly well below the percentage of delinquencies we were at when folks were throwing keys back to the bank in large numbers back in 2008, 9, and 10. And again, you don't throw your keys back to the bank on a home that you have the lowest interest rate of all time on, home equity built up, and that you're current on your mortgage. And so I think this is the biggest point to counter those folks who think we're just going to wait for the foreclosure crisis, is that, you know, we just don't seem to have the same ingredients bubbling under the surface for a major REO wave for that reason. And with inventory so tight, I think that precludes the major price declines that many are projecting. And again, California is doing better on this metric than many other states in the nation. So not only is this not a widespread kind of systemic issue, Californians in particular are really prioritizing housing, I think, for a number of reasons that we can talk about in the Q&A. But the bottom line is that this lock-in effect is really causing inventory to, you know, be tighter than it's ever been before. And as tight as the last couple of years have been, we're actually putting less homes onto the MLS today. And this is the number of new listings that get put onto the MLS week by week, running right up through the 10th of this month. And you can see that we're putting less homes onto the MLS today than we were even at the beginning of last year, right? When inventory was at an all-time low level. And even with today's relatively depressed level of sales, if you look at the number of closed and pending transactions each week and hold them up next to these numbers, which are the new listings getting added to the MLS, the net effect is that active listings, right, the amount of homes that are actually available for sale at any given point in time, is tight and getting tighter every week, right? The number of actives out there fell below 30,000 last month, and it's been there for the last 6 weeks in a row. We have fewer homes available for sale on the market today than we did even back in April of 2020 when the economy was in a complete shutdown. And I think this is the biggest differentiating factor between where we are now, where unsold inventory is still in the 3 months of supply range, and where we were back in 2008, where at one point in time we had almost 18 months of inventory available for sale, both because of the short sales, REOs, and just sellers trying to get ahead of the curve and dump these properties before prices really decline. And again, that doesn't create the scenario for precipitous price declines with inventory falling back to the all-time low levels, because we're just simply having homeowners that are so reluctant to sell those properties with these very low fixed rate mortgages that they're sitting on. And indeed, what you see is that as rates come down even a little bit, the market gets right back to becoming more competitive. So at one point in time, as rates started to go up last summer, you could see that median days on market went from roughly 7 at the beginning of last year all the way up to 42 days during January, when rates were approaching 7% again. But as rates came back down in February and then was kind of exacerbated by this flight to safety with Silicon Valley Bank, we're back down below 20 days last week as the median time on market for a closed sale. And so in some ways, I think buyers already missed a big opportunity when rates were down at 6%. And homes were taking a lot longer to sell with such a shortage of homes on the market. What you see is that any even modest movement in interest rates causes the competitiveness to heat right back up again, and homes are selling quickly. And again, this isn't a recipe for sellers to start slashing price. When homes are selling more quickly and buyers are coming back into the market, and there's such limited amount of supply out there, you just don't have to negotiate as fiercely as what many buyers are actually out there expecting. You could see the same thing if you look at price reductions. If you go back to October, November of last year, when rates were at 7%, you had almost half of all the active listings out there that had done a price reduction in order to get buyers to come back into the market. Well, if you look at what's happened since then, those numbers have been sliding. Fewer and fewer sellers are actually reducing price. They don't have to when they're one of the only homes actually available for sale in their zip code, in their own price segment. And you can see that last week we had fewer than 30% of actives out there that had done a price reduction. And so I think that buyers have a window of opportunity as other buyers have kind of taken that step back, but it's rapidly reverting back to that hyper competitive environment that we saw throughout the pandemic. And you could see the same thing if you look at homes selling above list. And this is something that you all are telling me out in the field pretty consistently as well, is that starting to get multiple offers again, right? And you could see that the percentage selling above list, although down from the 3 out of 4 homes that we were at when rates were 3%, is double what it was in January when rates were at 7%. And so it doesn't take much new buyer activity to cause the market to really tighten right back up. And again, this is all a function of just how tight supply is and how few homes are actually available for sale in any particular market. And I think this is the reason why both our transaction forecast is relatively pessimistic, simply because we can't sell what's not for sale. And if we don't have the units on the MLS, we can't get back to 400,000 or 500,000 sales the way that we enjoyed when we were running so hot back in 2021 and the beginning of 2022. But it's also going to be the thing, I think, that ultimately proves your brother-in-law wrong, that the bottom's not going to fall out for prices. Because again, you don't foreclose on a home where you've got the lowest rate of all time and lots of buyers lined up to take that off your hands when you have home equity, a home that's actually worth more than what you owe on it. So again, it's kind of an on the one hand, on the other hand kind of a story where, yes, we're not going to see that rapid rebound in sales, but we're also not going to see those huge snowball effects start rolling downhill when it comes to prices either. And of course, I think the other big thing we need to do is start evangelizing again for home ownership. And when I send you these, you'll have some of my favorite quotes from the Harvard Joint Center for Housing Studies talking about just how good home ownership is for wealth accumulation and how it's the only source of wealth, even after taking into account the last housing cycle where there were so many foreclosures. They find that even though you can come up with a model on paper that talks about how as a renter you could make some really good investments and come out ahead of where you would have been as a homeowner, in practice they never observe those outcomes. We need to remind folks that home ownership is about the long term, right? It's the one and only way that folks accumulate wealth in this country. If you look at the net wealth of the typical household, it's about $122,000. But if you break that down between owners and renters, it tells you everything you need to know about why you want to be in the housing market. It's not about, timing the market perfectly and buying low and selling high. It's about getting your foot on the property ladder and reaping those long-term benefits of home ownership, which again are the only ways that folks actually accumulate wealth. You can see on this chart that renters are no better off as of the most recent Fed data than they were 40 years ago. You do not end up making all of these great financial investments as a renter. You end up consuming that extra income that you would have spent on your mortgage and never end up getting any better off financially or creating any of those intergenerational benefits that are just so well documented in the academic literature, including better educational outcomes, test scores, graduation rates, percentage of folks who get a college degree, and higher income associated therein, fewer opportunities or potential for chronic illness, for health issues from the kids of homeowners, better outcomes for us as communities, more civic engagement, less crime in areas that are highly homeowner driven. And so there's both the kind of tangible financial benefits, the better outcomes for yourself and your children and your grandchildren moving forward. And of course, forgetting that even if prices do come down a little bit, California has a structural imbalance in its economy, meaning that over the long run, prices in California only ever go one way. And that's because we simply have too many people in this state. We've gone from almost 25 million people or a little bit more back in the 80s to almost 40 million today. And we build far fewer homes. In fact, 2022 was actually a good year for home building, and it was less than half roughly of where we were back in the 80s. And so you can't have a huge booming population base with a fast growing economy and build a lot less homes and not have homes do anything but appreciate. And I think that fact is undiminished by the long run trend. And so yes, if you look at our forecasts and our housing affordability numbers, they're bad. But, and I think the economy could get a little bit worse before it starts to get better. But over the long term, home ownership is still the one and only way that we accumulate wealth. Yes, we do have a modest recession baked in, with unemployment going up from 3.5% last year to about 4.5% this year. That is not a dire recession by any stretch, but I do think we can expect the momentum to cool, even if we don't kind of meet the technical definition of a recession. If you think about what that means for housing, we do have home sales coming down 16% this year after a 23% decline last year. But if you actually look at the number of transactions we're forecasting, it's about 290,000 units. And if you remember back to the transaction chart I already showed you, we'd already hit about 240,000 back in January and December, meaning that it's not going to get materially worse from where we are right now. It's just going to take a while for us to get back up to that 444,000 unit pace that we hit in 2021. Yes, prices will probably soften, and we'll see even maybe a couple of months of double-digit declines on a year-to-year basis. But we're not going to see the bottom fall out of the market because, again, inventory is just simply too tight. And I know I've gone on for almost the entire period, but Laura said we could entertain some questions if you have any, and I haven't beat you into submission. But first, I would just say thank you so much to the Education Committee and to Laura for having me, and thank you all so much for your time. And I'm not seeing any questions come up, so maybe I did beat you into submission. Well, I'll put my email out there in case any questions do come up as you're going about your business. It's jordanl@car.org, or you can call me anytime with questions. We have lots of good data on our website that I'd be happy to show you. And my phone number is 805-538-4290. I do see that gave me one question, which is how soon do you see the inventory in California increasing? And I think that it's a great question. And one of the points I didn't make is that I think this is going to persist beyond just the immediate housing cycle. Because, if you think about what's keeping inventory so tight, I really do think a big part is those very low rate mortgages. And I think that that's going to be around for a while, because I don't see rates getting back down to 2.65% in my lifetime. and you know, even if we do see things normalize and we get down to 5.5%, you've got a lot of homeowners out there below 4 and 3%, and so I think that that is going to persist for a very long time. Our website is car.org, so I'll put that in the chat. I don't know if everyone can see that. I will also put my email and phone number in there, and hopefully you'll be able to see it. It just says host and panelist, so I'm not sure it'll show up, but I'll repeat it again as well. jordanl@car.org, and my phone number is 805-538-4290. I've tried to put those in the chat, but I don't know if they'll show up. Peter asked if we're looking for a short decline in prices and for how long and when. Yes, we're looking for a decline in prices, and I think we're already seeing it. Prices have been falling on a month-to-month basis. For the last 6 months or so in a row, we've had 3 months in a row of price declines on a year-to-year basis, but only to the tune of about 4.8%. Our forecast is for an annual decline of about 8.8%. Keep in mind, as we get into the summer, that's when prices were at an all-time high last year. So it's not out of the realm of reason, Peter, that we could see the year-to-year comparison show double-digit declines as we get into April, May, and June. But I think, you know, when you look at it from an annual standpoint, prices as a whole will be down somewhere in the single-digit range, again, because we won't see the bottom fall out of the market with inventory as tight as it is. We'll see some moderation from those all-time highs because not as many buyers qualify for the same amount of home, at least as they used to, but you will you know, still see a lot of high income home buyers out there trying to take advantage while rates have come back closer to 6 than they are to 7%. Rich, I will send these out to Laura and company at the association, and if they send a follow-up email, they're more than welcome to include those slides. I see that Laura's having some technical difficulties, but I will also post them on car.org. If you go to our presentation archive, you'll be able to download them there as well. Or you can always just email me, again, jordanl@car.org, and I'll send them to you directly. These are for you to use, and I'll make sure to correct that one typo on that slide so that it says Conejo Simi Valley instead of Central Valley. And I apologize for that one mistake. All right. Well, I so appreciate the opportunity. I appreciate all of your time and attention. I hope that was helpful, but if there's outstanding questions that come up, don't be afraid to reach out. I work for you, and I'm here to help you put buyers into those homes, and however I can help, we'll do it.
Thank you so much, Jordan.
I appreciate you all. We'll see you on the next one.